All right, welcome back to another episode of Asset Coach and Tax Strategist. And oh my goodness, it took me about a week to settle down from cash flow quadrant. I don't know. You may have turned it off and you're like, this dude is crazy. But I just, as you can see, I just have so much passion in this, and I just get so excited about this, and I just want to pour and share and give as much as I possibly can. And so today. Actually, we're going to take a little shift. And so we talked about cash flow quadrant, the kind of the foundation to that of talking about cash flow the week before, the episode before. So today we're going to talk about Richest Man in Babylon. And this is an old book, old stories written back in the 20s, I believe it was, 1920s. Sorry, we're in the 2020s. Holy cow. A year ago, a century ago. And Richest Man in Babylon, there's 7 rules that really pertain to today. They really do. And it's kind of like the 10 Commandments. And I think it's really important. And we don't talk about this enough in finance. We don't talk about this enough in just when we're talking about money. And the reason being, it's like the 10 Commandments. Boring. We know we shouldn't kill. Duh. We know we shouldn't lie. Duh. Right? But people do. People do kill. People do lie. You lie. I've lied. Thank God I get the opportunity to go to confession and say, I'm sorry. Or go to the individual I lied to and say, I'm sorry. I actually was mistaken. I misspoke, or whatever the case, right? We have that opportunity to correct it. The same thing with what we're talking about with the richest man in Babylon. And so let's look at these rules and talk about it. So again, 1929, look at that. So we're almost at a century, okay? And George Samuel Clayson, and basics of money. Basics of money. And this is such a important, it's a little thing, little thin thing. I think it's like 100 pages or whatever. But rule number 1, start thy purse to fatten. Oh. No wonder it was written 1920. That we talk like we're in the 1920s. What's it mean? Pay yourself first. Pay yourself first. Now, if you're not a business owner, what most people will do as an employee is they'll tell you to contribute to your company 401k. Not a bad idea if you're an employee, right? Mortgage, buy your house. Not a bad idea if you're an employee. But you're not. You're not. You're a business owner. You're an entrepreneur. And I say cart before the horse. I say, yeah, okay, better than renting. But should we have a mortgage? No. One of the first things we want to do is pay off our mortgage. Oh, Bob, you can't do that. My CPA says then I can't deduct the interest from my loans. Good. One thing they don't tell you is that so let's break this down here really quickly, okay? And I have a whole course. Actually, we'll do a whole video on this episode on mortgages. So hopefully my team reminds me. Hopefully you remind me. So, but anyways, let's look at this. So let's say your mortgage is $3,000 a month, okay? This may be a little high. This may be a little low. Don't care. Where does this mortgage payment come from? Your personal checking account. So how did you get to your personal checking account? Came from your business. Oh, so it came from revenue, cash flow in the business, flow down the income funnel will be another episode, our income funnel, which means that cash flow becomes taxable income to you. So in reality, this is probably more 4,500 in cash flow, right? To net out 3,000 in your bank account. So that $1,500 is taxes. Okay. Oh, okay. So this is principal and interest. So what happens with your mortgage? So it's an amortization schedule. The first payment is mostly interest and less principal, right? So we'll do principal down here. We'll do interest here. And every month, every year until you hit your 30 years, they go like this. So about the first 7 to 10 years, you're paying more interest. Now, what happens when your interest rates go down? What do you do with your mortgage? You refinance it. Well, but you just said your interest payments, your interest on your mortgage is you get to deduct it from taxes. And so now what happened? You just reduced your tax savings because you refinanced your mortgage. You see that? So, but think about this. $1,500 a month, that's $18,000 a year in taxes. And let's say that on average, your interest is $2,000. So that's $24,000 a year, right? So take a look at this. Take a look at this. So you paid $18,000, so that's $24,000, and let's say a 24% tax bracket. So what is that? So 24,000 times 0.24. So here's your tax savings. Congratulations. You saved $5,700 in taxes. Yes. What'd you spend? $18,000. Oh. Who wins? The government. That's why they want you to buy a house. Okay. Now, again, what did I say about debt? There has to be a purpose, a plan. Okay. Anyways, so you're a business owner. We need to think differently. So let's pay ourselves first, but let's use our business cash flow, excuse me, as our guide. Okay. So rule number 2, control your spending. I just showed you an example of that. Knowing where you're spending your money, right? Hey, we tell people, we do, when people come to us, we do a mapping of their cash flow. So what we do is that we have our bookkeeping team. You give us 12 months of your personal bank statements. And what they'll do is they'll break down your monthly expenses and income by parts a month. So 1st to the 14th of the month, 15th to the end of the month. Why? Because that's usually when we get paid. That's when we usually have bills owed. So we need to know what our cash flow map looks like in the 1st of the month. Why? Because that controls our cash of income. We can get closer to our fair share of taxes when we know what income we actually need and when we need it and what that looks like. Okay. And sometimes we're able to find certain spending that actually can be done through the business that you're doing personally, that you have that tax consequence. And a lot of times people go, oh my goodness, I did not know we spend that much money on that. And what was the tax liability on that? Holy cow, we got to stop that. I'm not going to tell you to do that. Sure, money, do whatever you want. You've earned it, you spend it. It's my job to teach you and help you. Rule number 3, make thy goal to multiply. Earn a fair rate of return. What's fair? Is it 12% or is it 6%? Depends on the risk, right? Depends on the risk. Well, my financial advisor says I should probably put money in the S&P 500. Great. Why? Well, because it's diversified among 500 companies. No, it's not. There's 7 companies that drive the return on the S&P 500. The other 493 are barely breaking even. Is that diversified? And by the way, they're all tech companies. So at the end of the day, what kind of risk are you taking? I don't know. So earn a fair rate of return. What's that mean? That's a great question. That's what we got to find out. Rule number 4, guard thy treasures from loss. Don't lose money. Don't lose money. It goes back to this part. Earn a fair rate of return. Don't take too much risk to where you're losing money. Warren Buffett says the first rule to investing, don't lose money. The second rule to investing is don't forget the first rule. Don't lose money, because when you lose money, then you got to not only make up the money to break even, but then you've lost time. What's an economic termite? Time. Very important. We got to understand that. 1929. I mean, think about that. Is when this book came out. Rule number 5, make thy dwelling profitable investment. Own real estate. Now they're saying a house, right? And it's 1929. Own real estate. Well, oh, Bob, we do. We have tons of real estate. but you're not a real estate professional, so you're not getting tax benefits from it. How are you owning real estate? What time are you putting in real estate? What's your outcome of real estate? Do you know when to sell real estate? I have a client that's been a client for years. He refuses to sell his 3 condos because he bought them in the early 2000s. He got a good deal. He has now fallen in love with these condos, and I've told him, sell them, take the profit. You'll never get more money out of it from an income stream than what you can by selling it. Take that profit, put it into a bigger property. These 3 condos can probably yield about 1.5, 2 million. Okay, that we can 1035. Let's say half of it is there's debt on half of it. Okay, so let's say 750,000 you can 1035 into maybe an apartment complex or ownership of an apartment complex, partial ownership, and you get tax benefits from that through the partnership. And now you have 300 units working for you rather than 3 single units. Okay. But again, it depends. But you got to understand what you want as your outcome. You can't fall in love with this unless, if you say your house is an investment, then you cannot fall in love with it. But if it's your house is your home, then it's not an investment. We got to use our words correctly because of what we want from these words. Okay. Rule number 6, ensure future income. Protect your family. Well, that's not what that means. Yeah, it's exactly what. Protect your family by putting certain insurances in place. Now, do you mean like life insurance and homeowners or yeah, those are a part of insurance. But what is the purpose of insurance? Protection of your future income. So maybe you don't just own all real estate. Maybe you own some other assets. Maybe you just don't own only your medical practice or surgery center or your business. Maybe you buy the building your business is in. Maybe you start and invest in another business that's not correlated or not in the same industry as your business. That's protecting your future income. If COVID didn't teach you anything, that the government, your local mayor, can shut you down because you're not essential. If you did not learn from that, shame on you. Wake up, crawl out from that freaking rock. We got to protect ourselves. So that means we need to figure out what that next thing is. We don't know what it is. We name it when it happens. The Great Depression wasn't, they didn't predict it and they call it the Great Depression before it happened. It happened. And afterwards, they're like, wow, that was a Great Depression. We're all depressed. Let's call it the Great Depression, right? I mean, Black Monday in October in 87, that Friday before, they go, hey, let's call this next Monday Black Monday. No, no, right? Let's call the tech bubble. Let's call the tech bubble a bubble. Now, people predicted that would happen. Right, that technologies would go down and there would be issues, but there was corporate scandal, right? There's a bunch of other stuff, Enron, WorldCom, MCI. I mean, there was a lot of other stuff that went down too. Then what happened in 08? The Great Financial Crisis, right? And it wasn't the Great Depression; it was a Great Financial Crisis. Too big to fail, right? Economic termites, laws and regulations, too big to fail came into place and safeguards, and we're going to protect everybody. No, we're going to control everybody. Okay. These are all examples of protecting your family. All this stuff happened. We all survived it. Yeah. But maybe you should think about how to put yourself, your business, your family in a situation to where you don't have to suffer as much. We're not going to get away from suffering. But we certainly can make decisions to minimize or limit it. Don't we all want our kids to have a better childhood than we had or have more than what we had? Every generation's like that. To a fault, but that's a different conversation. Rule number 7, increase thy ability to earn. Increase your ability to earn. There's nothing else to say about that. How? I've just talked about it in the last episode of the asset quadrant with Robert Kiyosaki's cash flow quadrant, the asset quadrant, the investment quadrant. I just talked about it in rule number 6, right? Look at other situations. If you don't know how to multiply, if you don't know how to earn more than what you're doing, this is great. This is one of the things we see in our coaching all the time, is a lot of times there's business owners who can make a tweak here, a tweak there, and completely change their business model. Completely change it and increase income just in their own business. But what they don't do is look for outside advice. When we hire a new employee, that employee is the most important person in our business. Why? Fresh eyes, fresh ears. They don't know our language. They don't know our history. They don't know who we are per se. So when we teach them and train them and bring them up to speed on certain aspects of certain aspects of what we do, they have the ability to go, oh, I don't understand that. Oh, maybe we should do a better job of explaining that. Huh, great, okay. Oh, but what about this, and this? Oh, that was great. Yeah. Hey, guys, you hear that? They said, what about this, and this? And then we can add that. Right now, you don't just go hire employees to get fresh eyes. But my point is that we, a lot of times in our businesses, don't look for outside counsel and help to help us build our business. Now, it's hard because we got social media. We have a lot of ads. We have a lot of people who say they can do things and they don't. Right. That's tough. So you do have to sift through the weeds to find the really good stock to be able to harvest from. Okay. And that's why we added coaching to ours and what we do, right? Because we just found that, man, this isn't out there. We got to, not only are we going to do tax savings and wealth accumulation, but let's talk about between the years. Let's talk about the value of reading other books and using them as textbooks and understanding certain aspects of, right? We eat our own cooking. Everything we teach our business owner clients to do, we do. We do first, and we're like, oh, yes, let's do this. So we can show you what we have done as an example for you. So it's not like, oh, you're just sitting in your office telling me to do something you've never done. No, not at all. We're doing it. We're doing it. So rule number 8, I added. This was not in the original book. I was not alive in 1929. I added rule number 8. Pay thy fair share in taxes. What does that mean? That's the whole problem. There is no definition for everybody. It is a definition specifically for you. And so what does fair share mean? Got to look at your assets, got to look at what you're doing, got to look at your cash flow. We got to map out your personal cash flow. We got to understand the business financials and what you paid in taxes. We understand your business. Are there certain things in your business that you actually have credits, tax credits you have access to, and the IRS actually gives you the opportunity to go back 3 years to amend tax returns. 3 years to amend tax returns. Why? So they know that how cash flow, how businesses work. They know that, oh, wow, yeah, I actually qualified for some of those credits in my research. You can go file an amendment on your return, get those credits, and get a refund of taxes that you paid, because now they are overpayment of taxes because you qualified for that credit. A credit is a dollar for dollar. Dollar for dollar. So some of our business owner clients, we come in and that's what we do is we're not just saving money on taxes in the current tax year, but we're looking at, could we have saved money in previous years? If so, what guidelines does the IRS allow us to do? States do this as well. California, it's 4 years. California allows you to amend 4 years past returns. That's shocking to me. Not all states will allow it, but they allow 4 years. At some point they're going to stop doing that. I don't know. It just seems there's some things that California does. I'm like, really? Wow, that's cool. And then there's things they do. Obviously, we all know. Go emoji, right? I mean, ridiculous. But these are the 8 rules to the 7 rules plus 1 bonus rule by Bob Wolf, terra firma. You get rule number 8 as a bonus. This is important. You're a business owner, or you're somebody who wants to be a business owner, or you're somebody who is a business owner. You want to take your business to the next level. We got to look at all this stuff. It's so, so vital and important. But anyways, thanks for joining us. Hopefully this was helpful. I mean, wow, it's so amazing. Back in 1929, we had such wisdom that most people don't know this exists and aren't following this stuff, or even know that they should be, or right, oh, I've heard this or heard that, right, in the halls or the water cooler or whatever. But my goodness, this is so important and part of your planning. So thanks for joining us. God bless. Take care.